Investing, a complex financial endeavor, carries the potential for substantial wealth creation when executed astutely. However, it is riddled with prevalent myths that often thwart individuals from making informed decisions. These myths, if left unaddressed, can significantly hinder wealth accumulation and impede financial growth. The purpose of this essay is to meticulously debunk several entrenched investment myths that potentially obstruct your path to achieving financial prosperity. Myth 1. Investing is exclusively attainable for the wealthy. A prevailing misconception is the erroneous belief that investment opportunities are exclusively within the reach of the affluent. This fallacy springs from the notion that a substantial capital base is an imperative prerequisite for entry into the realm of investment. Contrarily, the advent of technological advancements and the proliferation of online platforms have democratized investment, extending participation to individuals with even modest financial means. The concept of micro-investing is illustrative of this phenomenon, facilitating the initiation of investment activities with minimal funds. Illustrative example: a young professional, Lisa, with limited savings, employs a micro-investing platform to allocate small portions of her income into diversified investment portfolios, gradually amassing wealth over time. Myth 2. Investing is a kind of speculative gambling. An entrenched misconception likens investing to a form of speculative gambling, erroneously obscuring the significant differences that separate these activities. Gambling hinges on chance and luck, while investing is grounded in thorough research, meticulous analysis, and strategic decision-making. Accomplished investors base their choices on comprehensive evaluations of market trends, corporate performance, and economic indicators. While risk remains an intrinsic element, informed investors seek to diligently manage and mitigate this risk through calculated planning. Illustrative example: John, a seasoned investor, diligently studies market trends and thoroughly assesses financial reports before committing to any investment, employing a methodical approach distinct from the capricious nature of gambling. Myth 3. Precise timing of market movements is attainable. The misguided notion that one can consistently predict market fluctuations and accordingly engage in the impeccable timing of market entry and exit constitutes a perilous fallacy. The practice of market timing, characterized by the endeavor to purchase securities at their lowest point and divest them at their peak, is an intricate art even seasoned professionals find arduous to master. Market timing often results in missed opportunities or substantial financial losses. Rather, a prudent strategy is adopting a long-term perspective that accentuates the overall health of investments. Illustrative example: Maria's endeavor to time the market proved futile when her attempts to predict short-term price movements led to substantial losses, underscoring the challenges associated with accurately gauging market trends. Myth 4. Safe investments invariably yield high returns. A pervasive misconception propagates the belief that investments boasting guaranteed returns, such as savings accounts or government bonds, epitomize the zenith of safety in investment endeavors. However, while these options offer a degree of stability, they frequently yield returns that may fail to outpace the insidious impact of inflation. The attainment of significant wealth necessitates a meticulously curated portfolio that encompasses a diversified array of asset classes, including equities, bonds, and real estate, to meticulously balance the interplay between risk and reward. Illustrative example: Robert's steadfast reliance on low-yield savings accounts as his sole investment avenue culminated in the gradual erosion of his purchasing power over time, underscoring the importance of diversification for achieving satisfactory returns. Myth 5. Insider tips are a viable route to investment success. The allure of exclusive insider information as a shortcut to investment success holds limited validity and potentially entails legal repercussions and financial losses. Insider trading, the act of exploiting non-public information for personal gain, is both unlawful and ethically reprehensible. The vast majority of accomplished investors predicate their decisions on publicly available data and comprehensive research. Relying on inside information not only imperils financial stability but also erodes the trust that underpins the investment ecosystem. Illustrative example: Mark's ill-advised attempt to capitalize on insider information led to legal ramifications and significant monetary penalties, highlighting the perils associated with seeking unjust advantages in the investment realm. Myth 6. Frequent trading is inherently profitable. The practice of frequent trading, often referred to as churning, may seem alluring due to its appearance of active engagement. However, this approach frequently incurs elevated transaction costs, taxes, and often results in inconsistent financial outcomes. Engaging in frequent trades can precipitate emotionally driven decisions and preclude investors from capitalizing on the compounding growth that materializes over the long term. An efficacious investment strategy demands a balanced and patient approach, enabling investments to mature and yield substantial returns. Illustrative example: Emma's penchant for frequent trading resulted in mounting transaction fees and erratic investment outcomes, starkly contrasting with the steady growth achieved by adhering to a disciplined, long-term investment strategy. Myth 7. Investing in trending assets guarantees profit. The fallacious belief that investing in assets currently in vogue or enjoying substantial media attention ensures guaranteed profits is fraught with peril. Market sentiment is highly volatile, rendering assets susceptible to overvaluation and sudden price downturns. Constructing a robust investment strategy hinges on meticulous research, comprehensive analysis of long-term prospects, and alignment with personal financial objectives, rather than capitulating to the whims of transient trends. Illustrative example: Sophie's decision to invest heavily in a hiked cryptocurrency yielded short-term gains, but ultimately led to substantial losses when the market sentiment swiftly reversed, highlighting the volatility inherent in trendy investments. Myth 8. Investment should commence with accumulation of greater capital. The procrastination of initiating investment activities until a larger corpus of funds is amassed is a detrimental inclination. Succumbing to this tendency can culminate in forfeiting opportunities to harness the power of compounding, an exponential growth mechanism that thrives on time. Even modest and consistent investments can generate significant wealth over protracted periods. Commencing early and adhering to a disciplined approach transcends the temptation to delay investment activities. Illustrative example: David, acknowledging the power of compounding, embarked on a journey of consistent investments early in his career, reaping substantial rewards over time despite commencing with a comparatively small capital base. Myth 9. Active management always outperforms passive strategies. A prevailing belief suggests that active management, where fund managers actively select investments in an attempt to outperform the market, is superior to passive investment strategies that mirror market indices. However, research has consistently shown that the majority of active managers fail to consistently beat market benchmarks over the long term. Passive strategies, which typically have lower fees, offer diversification and can yield competitive returns over time. Illustrative example: Amanda's decision to allocate her investments to actively managed funds resulted in higher fees and lower returns compared to a passive investment approach, highlighting the unpredictable nature of active management. Conclusion: thoroughly dispelling these deeply entrenched investment myths is pivotal for facilitating judicious and pragmatic financial decision-making. Clinging to these misconceptions can significantly impede the capacity to harness the manifold opportunities presented by the intricate world of financial markets. By embracing the truths underlying investment, its accessibility, the indispensability of rigorous research, the significance of adopting a long-term perspective, and the imperative of a diversified approach, individuals can surmount these myths and advance resolutely toward the realization of their financial ambitions. The realization that knowledge serves as a potent antidote to misinformation underscores the significance of an astutely informed investor capable of adeptly navigating the labyrinthine financial landscape.